The Commercial Real Estate Show is brought to you by Cone Resnick, forward-thinking advice to navigate business and financial issues. Visit ConeResnick.com. By BB&T, banking, business, and commercial real estate loans. Visit BB&T.com. And Bull Realty, when your business requires proven performance, visit BullRealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit FranceMediaInc.com. Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, I believe we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. If you have any questions or comments related to today's show or any commercial real estate related matters, you can give us an email at michael@CREshow.com or give us a call. Our phone number is 888-612-SHOW. Well, today we're going to look at the U.S. retail investment market. We'll also get the latest on sales tax fairness and then get a preview of what to expect at the International Council of Shopping Centers Recon Conference in Vegas, the retail event of the year. Please welcome my first guest, Dan Fasulo, Managing Director with RC Analytics. RC Analytics does a great job tracking sales of income-producing properties over $2.5 million or greater in the U.S. and $10 million or greater outside the U.S. Since 2007 alone, RCA has recorded over $5 trillion in commercial real estate transactions throughout 126 countries. Dan Fasulo, thanks for joining us today.
Thanks for having me back, Michael.
Well, we appreciate you spending some time with us today. And let's talk investment sales. How did retail sales volume and cap rates end up in 2012? And what do you see so far in 2013?
The Q4 of last year was a record-breaking year as far as sales volume goes for retail properties in the U.S. We saw, in aggregate, over $20 billion worth of retail property sales. That would put us back at, levels that we haven't seen since 2007. And actually, if you kind of break that out to just single property sales, excluding all the portfolio transactions in our world, Q4 was a record. There's no doubt in my mind that the January 1 deadline where the capital gains tax was going up really triggered a lot of transactions. A lot of discretionary sellers came to the table. And it's kind of flowing through the Q1. We think a lot of that transaction activity that might have happened this quarter got sucked into Q4 of last year as everyone rushed to kind of meet that deadline.
Yeah, that's a good point. We saw the same thing in our shop as people were rushing to get some sales done at the end of the year. We actually had a rather large transaction that for some reason didn't close. And then after the first year, guess what? The seller wanted more money.
Yeah. What was interesting, too, we're tracking pricing trends very closely. And, there was a presumption that there'd be a rush to get deals done and sellers would really drop pricing to meet the market. And it didn't really turn out that way. It's really, in Q4, the buyers came up to meet sellers' expectations. And that was probably partially fueled due to the lower mortgage rates that were available.
Yeah, that's interesting. The real good buyer demand. So, yeah, that's interesting that the prices continue to climb. So what do you see for cap rates, and what do you see for variances between the various classes and property types?
Yeah, there are vast differences, among different types of retail properties and obviously geographies. Nationwide, we're just above 7% for average cap rates, but that's the whole market. And we haven't really seen much movement over the last few quarters. But as I said, you really got to dig underneath. Where we really have seen some cap rate compression recently is in the secondary and tertiary markets, which were kind of late to the party a little bit. Everyone knows the kind of the major metro story and how investors have been all over that. There's been a fundamental shift of capital to higher yielding markets, and we're just in the early innings of that cycle.
Okay, so what does that mean moving forward? What will that do to cap rates and prices?
That means if you're sitting with a retail property with somewhat decent credit in your asset, and you're in a secondary or tertiary market, that means the capital's coming your way this year. Barring some sort of external event, this is the part of the cycle where both equity and debt capital spreads out around the country, and we're already seeing that process speed up this year.
Okay, and so which markets are hot right now, Dan?
Yeah, I mean, definitely the Sun Belt markets, where there's some nice yields. We're seeing money flow from the coasts, and especially single tenant properties are just being gobbled up right now by both the non-listed and then the publicly traded REITs, which seem to have just a unbelievable appetite for those types of properties.
Okay, and they don't care where those are almost, right? I mean, they're looking at the income stream and the strength of that tenant, right? So are those properties hot everywhere, basically? That's
absolutely right. I mean, investors are scrutinizing the tenant credit more than they might have in the past, but yeah, I mean, they're looking for yield.
Okay, and on the multi-tenant retail properties, where do you see the difference between malls and shopping centers and neighborhood retail? What do you see as the variances there?
Yeah, there wasn't many malls listed for sale last year. The ones that did trade, some of them had distress associated with them. A lot of the major mall owners have chosen to recap their assets, to refinance versus selling them outright. So our statistics are somewhat misleading because sales activity is down significantly for regional malls. But I think over the past few years there has been a fundamental repricing between kind of your think fortress, your prime fortress type assets, and then everything else. Mm-hmm. And we're really seeing second and third tier malls in every market really get. We haven't seen values recover for those types of assets, and especially the lower quality of the bunch are almost all redevelopment targets at this point.
Yeah, there's a lot of that going on, and we're talking with Dan Fasulo with Real Capital Analytics. And Dan, you mentioned that the REITs are buying the net lease properties. Who are the other buyers who are active in the market right now?
Yeah, I mean, there's been a lot of buyers, institutional investors that had focused on, office and multifamily earlier in this recovery cycle have now shifted to other property sectors like industrial and certainly retail because of the higher yields available. Kind of a 10-year high spread has opened up between office and multifamily and then the other property sectors, and has really started to attract capital to the retail sector. So, besides obviously the REITs that have been active, we've seen a whole host of pension fund capital and their advisors active in the space. We've seen some private equity, especially around the distressed portfolios. And then, for the first time this year, or over the last 12 months, we're really seeing private investors, small local developer, owner, operator types get back in the acquisition hunt again, because for the first time, the debt capital markets have started to open up for that crowd, especially with the resurgence of CMBS.
Okay, and we're short on the break here, Dan, but how about distress? How much of the volume is distress related?
Yeah, on a dollar value basis, we're really going into the later innings of the distress cycle. right now, Michael. There might be some localized issues with smaller properties, especially unanchored centers around the country. But from my perch, we're getting close to the end, and there's not much left. At this point, too, as far as overall property sales, distress is making up well less than 10% of that total sales activity. So it's, in my mind, it's the distress cycle is going to be done in a couple of years.
Okay, well, that's good news. Well, Dan Fasulo, thanks for joining us today.
Thanks, Michael.
For more information from Dan Fasulo and RC Analytics, visit rcanalytics.com. There may be some big changes headed our way related to sales tax being collected by online retailers. We'll get the latest for you and put it all in perspective. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is made available by professionals at Cone Resnick, BB&T, France Media, and Bull Realty. For more information about these companies or to access additional show podcasts or videos, visit commercialrealestateshow.com.